Hey everybody, welcome to Trading Capital's daily analysis video. It is currently June 30th and wrapping up the end of quarter two. Wow, was quarter two not just as interesting as quarter one? Hedge funds and investment portfolios were decimated in quarter one. There were a lot of optimistic people trying to search for some optimistic trends. You know, when you have significant declines, usually you're going to have the massive rebound. Well, quarter two was not the rebound. In fact, this is the worst start to the S&P 500 since 1970, down 20.6% for the first half of the year. That is an exceptional move to the downside. This is where it really starts to get interesting now, because how far are they going to let these markets slide? And due to the fact that I don't think unemployment has yet spiked to the levels where they will intervene, and the inflation level will have to come down significantly more to potentially a new base rate of 3 or 4%, I still think that we have got more headwinds for this market up ahead. Nonetheless, the bounces will be impeccable. That's why we play them. But down over 20% for the first start of the year. And the interesting thing about this being the worst start since the 1970s is what happened in the 70s. Well, 1971, the gold standard was officially abolished and removed. But the 70s were the period of high inflation. That's where these are all the trends that we are breaking and starting new cycles. Is we're entering an inflationary cycle in the 70s where we're now matching up with declines in the S&P 500 and the broad indices that are matching up with that same inflationary cycle. So we do have a roadmap. History doesn't repeat, but it often rhymes. That's Mark Twain, and I think it's truly an underestimated but such an obvious statement to really pay attention to and learn from. But overall, many of the indexes were down, a lot of red on the screen. If we look at the charts here, the S&P gapped down this morning, and it fizzled down, touched your support level, which was this trend line that we were talking about. And the interesting thing is we warned in our previous videos that since you had two gaps to the downside, which was this gap over here and this gap over here, it is more likely that now the price action was going to be pulled down into those gap zones and likely lower. And it just so happens that we got the gap down. But the interesting thing to note is when you have a gap over here that gaps over another gap and closes below that gap, it dictates, and this is the more likely scenario, that you're going to have continued downside. And that's certainly what we had. From that gap point, we had more downside. Usually a lot of people would be like, oh, we filled that gap, but technically you hadn't filled that gap because you just gapped over it. And the downside did ensue. Once you did come up here to fill this gap, it was your major resistance support. So that's the type of technical analysis that we need to learn from, is that when you have a gap and you gap over it, you're often going to retrace back to that gap, which was this move. You got your retrace back over here, and look at the high pivot on this reversal candle. It just pretty much filled your gap on an intraday basis. So usually when you're falling into a gap, it becomes support. But when you fall over a gap, the opposite is true. It's going to become resistance on the way up. And that's certainly what that was. We had another push down into your major pivots over here, and that was your buy signal. And it friggin' ripped up all the way to the upside, filling that gap. So right away, we took care of two gaps on the screen, and now we're just chopping. The beautiful thing is that we are above our original breakout line over here, and that's the retrace that we were looking for. We were looking for that retrace. You had your breakout over here. We were nervous about these gaps, and you had your retrace, and now I think the markets can get a bounce. And simply, one of the reasons why I think the markets can get a bounce, if we look at what is transpiring with the US 10-year yield, the US 10-year yield is very interesting right now. And, this is the opposite chart. Let me just look at the US 10Y. So if we look at the US 10-year yield, I am so fascinated by the yield, because if you flip to the daily chart, yields were under pressure all day. There's still 7 minutes left on this candle, but yields have been pushed down on the day. If we flip to the weekly, you had this weekly topping tail, which I don't really prefer it as a weekly topping tail, but if you look at this monthly, that's a monthly topping tail. So that 100% is a monthly topping tail because you have a longer wick, double the size of your body, as well as you've closed inside of that candle, which shows that I do believe yields have had a failed breakout in the sense that here is your resistance. You tried breaking out of it on this candle and you failed because you've closed back inside that candle. So typically when you fail a breakout, you go back down to your next major level of support. Let's just flip back to the daily chart. That next level of support is going to be on this blue line over here, your first minor support. And then ultimately, I do think you're going to have this pivot over zone over here. You have this pivot zone over here, and you're going to create another pivot zone over here. The question is we'll be watching very, very closely, because if yields fall too fast, and despite us not having inflation under control, it means a collapse of epic proportion is likely coming in the near term. And that's where we're also going to watch the correlation of gold and the correlation of interest rates. And if we simply look as to why I do think equities can get a bounce in the short term, not only are interest rates falling, but when you look at the DXY, nasty, nasty reversal candle. If we simply flip to the monthly chart on the DXY, also what looks to be a failed breakout. Reason being is you've had this reversal candle over here. This is the monthly chart of the dollar. So you hit your double top resistance. You had a nasty reversal on the previous month. This month you've retraced that full candle, pierced it. It looked like you were going to break out and failed to close above that candle. You've closed back inside that wick. So this reversal candle last month is still technically intact at the double top zone. It's a really thing of beauty. Now, I don't think the US dollar has the potential to collapse right away, but it does suggest that you should at least have a move down to the support zone over here around this 101, potentially a little bit lower to this $100 level. That would be a meaningful retrace. That would be a good retrace, enough for it to start basing and potentially building more momentum. But if we see yields continue to collapse, the US dollar will also continue to collapse. And the main thing that I'm going to watch as well is gold. Gold had a pretty interesting move today, a move to the downside, because what we have been talking about and discussing is this wedge pattern, that it's likely to break down to the downside. And today we got that close. Now, the one thing I'm watching with gold, and we have an hour left in this candle, is do we get a close below this pivot? I really want to see gold hold. You can see it pierced it, was looking like it was going to close below, but now it's slowly starting to recapture it. But this low green pivot over here is key. It's around 1806 or 1807, give or take $1. And if we get a close above that, that's certainly a little bit more bullish in the short term. If we get a close below that, you have a very likely scenario of testing this pivot at the 1786 level. If we break the 1786 level, this is what I'm really going to be watching for in terms of correlations to make sure that we get the hell out of the market in terms of our long positions and we start accumulating meaningful shorts. Even if the charts are telling me to get in for long, I don't want to be caught in a potential flash crash or a significant week of major selling, because what I'm looking for is, what I believe we're going through is a debt crisis, a credit crisis. Those are really the two names that you can throw around. You have heard none of the mainstream economists and analysts mention it, but definitely some of the more free thinker people and real economists have mentioned this. But what we're going to see, and I'm going to rephrase it, not what we're going to see, but if we see gold starting to fall and break key support levels, like really start falling, along with the US 10-year, so interest rates falling as well, what that signifies to me is we're going to be going through a liquidity crunch. And because interest rates are what caused the liquidity crunch, if interest rates are falling while gold is also falling, gold is the liquidity and interest rates are the liquidity crunch. So if interest rates are falling as well as gold is falling, that means people are running to liquidity, exiting, selling. Even though it's one of the best performing assets of 2022, they're still trying to just get cash, because gold is really the only liquidity. It's the liquidity that hasn't been decimated like many of the other sectors and stocks. So people will run to it and try to sell it, because it's not that they want to sell it, it's that they're forced to sell it either on margin calls, loan requirements. Who knows? Margin levels are still high, and they still need to be basically brought back down a notch before we can say that we've really had a capitulation, sell-off. But ultimately, the correlation, gold. If gold starts selling off hard and breaking major key supports, accompanied with interest rates collapsing, that's our sign that something nasty is brewing in the markets. Let's take a look at the NASDAQ because we didn't touch on the NASDAQ. The QQQ on the daily chart is still closing inside of this parallel channel. Despite the gap down, you did have a nice rally to recapture the channel. So that's bullish in the short term. It shows that this is still a decent level of support. Despite you broke it over here, you've recaptured it on this occasion. You're holding it into the end of the week. Well, tomorrow we'll have to see. Basically, tomorrow, if you close below this, then you have a sharp move down to the gap fill, potentially double bottom. If you can hold and start to rally, then it might suggest that we can stage a rally to fill this gap. And it does happen to match up with the original breakout zone where this was your breakout. You retrace back to the breakout zone, and now the NASDAQ and big cap tech, I do think, are in an oversold condition to potentially get a small, minor technical bounce, accompanied with interest rates falling and the US dollar weakening. So those are the three things that I'm going to watch in terms of cross-sector analysis, whether the indices get that extra bounce as rates fall and as indices fall, or if rates are falling, is gold selling off along with the indices, because then that's showing that nothing is really safe. None of the defensive assets or the risk assets are safe, because there's certainly a liquidity crunch coming. So there were a couple things that we did today. Congratulations on the trades that we did make. We banked, just over around 6% on Teladoc. That was just to cover our short. That was more or less a hedge on the portfolio, and I wanted to offload that because I do think the markets are going to get a bounce. We also added to our Canopy Growth. Canopy Growth got trounced today, but that's okay. It's one of those stocks that can move 50 to 100% in one day. Just on the speculation side of potential legalization in the states with midterm elections coming up, I do think that chatter we're going to hear over the coming months. Over the next, say, 1 to 3 months, we should start hearing politicians on both sides. I think it's going to be a promise from the Republicans and the Democrats to potentially sway voters on their side through the use of legalizing marijuana recreationally. So it's certainly going to be a big historic moment for the United States of America once they do that, and I do think it's only a matter of time. We did we did take a new trade today. So Air Canada, AC is the ticker. Let's just pull up that chart. So Air Canada, one of the reasons I added to Air Canada, let's just flip to the weekly chart. Weekly charts are a very, very powerful tool. So not only do we have a technical gap fill, which is where we added to on Air Canada, and you can see we've bounced nicely off that level, you also have this beautiful multi-year trend line of support connecting a pivot low in 2014, a pivot low in 2016, 2015, and then your COVID capitulation low, where you pierce through, and look what you just hit today. Boom, right on the money. So you had a confluence of technical factors. Not only do you have that, but if you simply draw this parallel channel where you were trading in for an extended period of time, where you have a low here, a high here, another low, a high, you've just been ping-ponging in this channel back and forth. So it does favor that you've had a sharp 3 or 4 week decline, a 5-week decline. This is actually a flat neutral day. There's no real gain on that day. So 5-week decline into support, massive technical level. It's a good enough level to start a position for me, as the charts are telling me you've had a beautiful, beautiful retrace all inside of this gap. The fact that Air Canada gapped up over here, and now you've had this amazing retrace. All of these people that have been buying in are either underwater or out of the position, but now we're ready to start to potentially resume a continued bounce to the upside. Taking a look at oil, beautiful, beautiful collapse on oil. This is just the things that dreams are made of. The reason that all of these investment hedge fund and institutional bulls, I can't understand how they've been so bullish on oil. Well, I can understand why they're bullish on oil. They're more long-term investors. They don't really, a lot of them do trade, but if they traded the short term and they were taking into account the macro, how powerful macroeconomics is, yes, there are supply demand issues in the oil industry in terms of how fast we're depleting our oil, in the sense that we're not really bringing on new supply, but the macro side, where the Fed is killing demand through the raising of interest rates and QT and putting us into a technical recession, and one could argue a lot worse, there's just too many factors, and the overall weight of macro analysis is going to trump any of the longer term fundamentals for oil. So in the short term, nothing is more powerful than the macro factors like a technical recession and fear in the markets, and certainly demand destruction. So you have to keep in mind, oil's been above $100 a barrel for just over 4 months now, 4.5 months to be exact. And in 2008, oil was above $100 a barrel for 4 months before the housing crisis and economy collapsed. So putting into perspective, we're very close to that cycle time where we're just actually over it. So one could argue the damage has actually that we're incurring this go around is arguably a lot worse than the previous round. And it is, and it does state that because inflation is a lot higher. But look at this beautiful broadening formation that we have been monitoring for quite some time. And now look at this price action. You had that close basically right on this candle, or one could argue just below, depending on how accurate my line is. I feel like it is pretty accurate, but needless to say, there's a little bit of room for error always. But let's assume that you've closed on that line. This is technically your confirmation. If you want to be a little more conservative, you can wait for a secondary confirmation candle, which we could get tomorrow. But needless to say, now that we've broken this level of support again, it now acts as a huge level of resistance. And now that we're approaching this level of support, which have been tagged multiple times, I do think we're going to break through that level sooner rather than later. You will have some support down here around the 94.95 level, which will essentially negate all of the buyers that rushed into this war trade, pretty much the speculative money that bought up oil and bought into the hype. You know, the price of oil that rallied from basically December of last year all the way up to here was pricing in a lot of that Ukraine-Russia tensions. This is hence this broadening formation. And essentially everything that happened here is just wacky doodle, people that have no understanding of the macro side of what our economy is going through and overall the supply-demand fundamentals around the world. So overall, I do think we got a break sooner rather than later, and fantastic job. We just shorted oil literally right at the highs over here. We got that retrace that we're looking for, and we're already deep in the money. If we simply pull up the SCO chart, that's just the micro chart, we're already in the money 12% in 2 days. So fantastic job, whoever's been banking money on this energy trade. We're in the driver's seat. We're holding the power now. We can lock in profits no matter what. I'll leave that up to you. I think I'm going to let this ride at the minimum to this 2380 level. But if we simply look, that's a gap fill up here, 2380, and then you have a secondary gap fill up here. I do think we're now coming into the position where we can potentially hold these trades for a lot longer. So let's assume it even goes up there. That would be a lovely game. That's another technical gap fill around the $27 level. So let's just monitor the price action, how it is. Obviously, some negative data can push oil a lot lower and energy is a lot lower. If we look at natural gas is a phenomenal decline. It makes us wonder if we should have held on to our KOLD. I know a couple members were mentioning it, but we did have that intraday bounce. I was looking for a retrace there to short it again, but we didn't quite get it. I didn't expect the inventories to crush natural gas so quickly. But needless to say, we did issue a day trade alert in our service, which is a rare thing to do. One of the reasons I did this is because I felt like all the members had the ability to do so because it wasn't as fast paced as it usually is in the morning. It was more of a slower grind level where I gave you the target range. I gave you a couple levels that the range that we should watch for. Obviously, if you don't have experience day trading, it's not recommended to do it. But if you do have experience day trading, it was certainly a very, I would say, an intermediate or a novice day trade that one could scalp profits on and bank a decent amount of money. So one of the reasons, if we flip to the UNG chart, I want to show you why we took this trade. Weekly UNG chart, I haven't showed you this before, but I've been watching this parallel symmetrical channel in the UNG chart for quite some time. Since 2012 bottom over here, you had a high over here in 2014, you kissed it again in 2014, a low in 2016, a high in 2018, another two lows here in 2020. So you have massive support at the bottom and you have massive resistance. Obviously, when you broke out of this resistance on this candle over here, naturally you get a retrace back to the breakout zone, which is what you got today. Look at that technical hit of this parallel channel. exactly where you broke out. These are the patterns and signals that I get so excited for. And that's one of the reasons why I wanted that range, is because right in there you had so much support. You also had the 50 weekly moving average, which is this purple line, and you had these major pivot tops over here. So an impeccable, and you also have a massive hardcore sell off to the downside. So that was one of the reasons we took that trade, needless to say, and we pretty much sold near the exact high of this, so banked around 19 cents personally. And a lot of you could have had a better entry than myself, which just shows you the power of basically incorporating multiple technical factors in one trade alert. So beautiful job on that. Natural gas is getting interesting now for a potential bounce. I am watching it closely on the UNG. If it pierces this level, I'm going to look to acquire starting around this gap fill around the 1744. Basically anything in the around the 1774 all the way to this 1577. Those are my ranges that I'm going to start to look to acquire. And I'll probably spread out my buys over a 1/4 or 1/5 of a position, just due to the fact that it is getting so oversold in the short term. So basically, yeah, 1/4 or 1/5 in terms of position sizing, which means, you do 1/5 here, 2/5 here, 3/5 here, or 1/4 here, 2/4 here, 3/4 here. So essentially position management is very difficult. That's the one thing that most people struggle on, and you have to really ask yourself and do a risk analysis on whatever trade you're doing. Any single trade, you have to do a risk analysis and what you are comfortable in terms of putting in a trade, because you have to go into the trade that you could lose a potential amount on that money. Never ever assume you're going to win a trade. What sets rookie and novice traders apart from professional traders is the simple fact that professional traders, when they are finding a trade, they don't look at what are the positives for this trade. We look at the negatives. What are the catalysts that could cause us to lose money on this trade? And if you look at that, those are going to just eliminate so many garbage rushed chasing trades that would often get you in trouble. So we'll just have to continue to monitor these markets. There is the final day of the week tomorrow. I do think the volume will be light, which should favor some upside. I do think since you're closed back above support, filled that key gap, the markets should stage a small little bit of a rally. Today we had the crazy volatility because it was end of the month, final day rebalancing of portfolios where institutions cut losers, they add to winners to make it seem like they're more overweight in this, and there's a lot of just game playing tactics to essentially make their portfolios look better for the quarterly statements. So that is it for today. We also did start accumulating another crypto position. We're in Bitcoin just around 19,000 and Ethereum around 1,000. So we're starting to accumulate for another swing. I do think we can get those bounces in those crypto assets because they are still technically oversold, and we'll just have to continue to monitor and make sure they do hold support. And one of the reasons I am not afraid to accumulate swings more frequently at this level is because we are below that 20,000 threshold, where a lot of people are now accumulating longer term hodl positions, like core Bitcoin positions. And even if a swing trade goes wrong at these levels, that's not our goal. Our goal is to obviously have them go right, but we are at the levels where you can just naturally leave your crypto at these levels and you would still have a great risk to reward ratio in terms of upside to downside. Now, do I think crypto and Bitcoin could still fall another 50 to 80%? Yes, I do. But that's why we are prepared in terms of the position management and scaling in at the necessary technical levels. Overall, in terms of what HODL means, in case nobody knows, it means hold on for dear life because crypto is certainly volatile. I mean, you get the volatility to the upside, you get the volatility to the downside, but once we start reaching these lower levels on crypto, I imagine these bounces can be pretty impeccable for us traders and even investors alike. I mean, the power of bear market bounces is truly, truly exceptional, and don't underestimate it. So that being said, with powerful bounces also comes sharp declines. You can't have the yin without the yang. So overall, we got to be prepared for both sides, and do not over leverage yourself in crypto or any other trades. Do not take on margin. Do not over exacerbate, because one wrong move can blow up your account pretty quickly these days, especially since there is still a lot of fear in the markets, with now 3 arrows being ordered to liquidate fully, and that's around 15,000 Bitcoin that they owe, plus 386 million in cash. So we're talking about $750 million that potentially could also be taken out of the crypto market. So that would put a short-term liquidity strain on the overall markets that could send prices lower. So let's just continue to monitor crypto over the weekend. Tomorrow should set the tone for what transpires over the weekend with crypto. Thank you for being members and subscribers. Please give this video a big like down below. If you have any comments or feedback, or like me to do any additional analysis, I'll be more than happy to help out and squeeze in any trades that I can or analysis in these videos. But please give this video a like or a comment down below, and let's continue to make